In this episode of Smart Humans, we talk with Charles Clinton, who's the co-founder and CEO of EquityMultiple. We talk to him about the world of real estate, what is happening with interest rate, and what is happening with different markets and different types of real estate. Should you be getting in now? Should you wait? Which geographies should you invest into? And which types of real estate investments are right for you today? And of course, we ask him for his predictions for 3 years out.
Welcome to Smart Humans with Slava Rubin, presented by Vincent. In this alt investing podcast, Slava talks to amazing minds about their investment journey and finds out what it takes to make it in the markets. And now, here's your host and smart human, Slava Rubin.
I am excited to tell you all about Air Insider, the private market investor's unfair advantage. Every week, you get public and private market investment picks from industry experts like Jason Calacanis, Anthony Scaramucci, and of course me. You'll get access to exclusive monthly briefings as well. Right now, we are offering the first year at 50% off, which is less than $10 per month. We've also partnered with some of the best investment platforms and tools and gotten our members thousands of dollars of offers and discounts. This includes $50 off of free stock from Public, up to $250 of free investment credit from Percent, and up to $1,000 of free gold from Argo, and a whole lot more. All of this for just under $10 per month. You can sign up at withvincent.com/insider. Again, that's withvincent.com/insider. Invest like an insider. Hello, and welcome to the latest episode of Smart Humans. I'm super excited for today's guest. We have an expert in all things real estate. We're going to be talking about where the market's at, where it's headed, and how you could be investing into this space. We have Charles Clinton, co-founder and CEO of EquityMultiple. Welcome, Charles, to the show.
Hey, Slava. Good to be here.
Absolutely. So we always get started in the same place with everybody, which is, how did you ever even enter into this world? Meaning, take us back as far as much as you'd like, whether it's childhood, college, wherever you started, the impetus of how you landed into this spot.
Yeah, absolutely. So my path was a little circuitous, I'd say. I grew up in a house that was not investment savvy. I did not grow up with basic financial literacy, kind of accumulated it over the course of college and post-college life. And like many people who are ambitious but don't know exactly what they want to do, I ended up in law school and came out of law school, went to work at one of the big white shoe firms in New York, Simpson Thacher. And, somewhat arbitrarily, I would say, I picked the real estate group. My only connection to real estate is growing up in New York City and being surrounded by big buildings all the time. I think something just gets in your blood to appreciate real estate. But it was a great landing place. The firm basically worked with all the best private equity firms. So Blackstone, KKR, Carlyle, really kind of high-end, sexy sort of transactions, which I liked, which was interesting. But what I realized pretty quickly is I didn't like being a lawyer. So I thought about, how do I get to the other side of the house? And the way I started was going out into deep Brooklyn on the weekends with a few friends and looking at little tiny multifamily buildings and trying to figure out what we could buy. And we realized pretty quickly that, working the ungodly hours of a young corporate lawyer and trying to be a landlord didn't line up too well. But what that taught me was, look, people want to invest in real estate, but it's hard. It's not actually easy to do. You can invest in public REITs, but, market goes up, REITs go up, markets goes down, REITs go down. It doesn't really have the true flavor of private market real estate investing and ownership and tax benefits associated with it. So, look, if anyone should have been able to figure out a way to invest in real estate, it's someone who's basically working with Blackstone every day, but I couldn't. And around the same time,
Sorry, you couldn't because you didn't have the
because I just didn't have access. I didn't
Right.
know, it's not like I could go up to someone at Blackstone and say, hey, can I put 50 grand into your $2 billion transaction? That whole world of private real estate investing was word of mouth and, know someone. And at the country club, that was really the industry for a long, long time. Then the Jobs Act happened in 2013 and, basically let businesses like EquityMultiple go online, start to market these private investments to individual investors and open up that access. So, look, the lawyer part of me definitely said, change in law, something big's going to happen out of this. Go and give it a try. And I linked up with a friend that I knew from the real estate world, Marius Schulson, and he was in, real estate private equity on the buy side for a long time. So we had good kind of complementary skills to get started. And yeah, we started back in 2015. So it's been a 10-year journey, a 10-year maturation of the business. And, here I am today, and we've done maybe 240 transactions. We've had 700 million invested through the platform. We've invested into over 5 billion of real estate. It's been an exciting ride.
Amazing. So you went straight from law school to being a lawyer on real estate to seeing the pain yourself, wanting to get access, didn't have the access. So you were just like, let's do it. Let's start it.
Absolutely. Absolutely. I mean, it sounds pretty dumb when you put it that way, but, I made the jump.
No, it's one of the more linear paths that we've actually had on the show. So it all is actually very logical. Now, let's talk about you personally in terms of your net worth. Obviously, you have a lot of probably your own net worth in your company. So let's just put that aside and let's talk about how you like to invest the rest of your money. So, because we here like to talk about alternative investments. So I'm guessing you probably put a little bit into real estate, or maybe you're
Yep.
going to say you put all of it into real estate. So let's start at the top level, which is, the classic move is 60-40 equities, bonds, zero alts. So what's your percentage? Is it 60-40-0 or is it 0-40-60? Just what's the first high level number of
Oh,
equities, bonds, all things alternative? And obviously all your
that's
real estate would be in all things alternative.
yeah, that's a great question. I'm over 50% into real estate, into alternative, and then I'm very light on bonds. I have some through retirement accounts, but basically equities and real estate. And from an equities perspective, I'll dabble in individual companies, but really I take the view that the market is the best thing to invest in. Most of what I'm in is, it's VU, S&P 500 indexes and that kind of thing. And, look, I think my view is you really have to be dialed into something to have an advantage. And you look at all the data and it says most people don't beat the market. So, my view is I know about real estate, have a ton of experience in it. So that's the place to make more of my individual bets. And then the rest of it is let's bet on the, greatest asset the world's ever seen, which is the US economy.
Nice. So you're about 50, uh, or let's call it your 45-5-50. Is that right? Which is like 45.
I'd say that's about right. Yeah.
And the 45, the equities, you're keeping it nice and simple. You're indexing it. You're not doing stock picking.
Yeah, yeah. I mean, I'll do some one-off stuff, especially look, the market's been so nuts, definitely got a little more adventurous over the last few months. But even then, right, like my idea of buying the dip is I want to buy an index at a dip ideally, but there's obviously areas where you just have a little bit more insight or feel like you do, and I'm happy to make a couple smaller bets in those.
And then in the alternatives, if that was 100% and you sliced it up, is it 100% of your 100% is real estate, or do you have any slices in the other alts, i.e., crypto, art, collectibles, private credit, pre-IPO venture outside your company?
I'm 100% real estate.
Nice.
Look, I got to put my money where my mouth is. I have, of course, many friends who tell me what an idiot I am for not having some exposure to crypto and, of course, get pushed on putting a few bucks into the other asset classes you mentioned. But, look, like I said, my general thesis is real estate one, it's not a home run category, but you can hit singles, doubles, and you'll get a triple, maybe a home run sometimes. And I'm making a big enough bet on startup stock,
Of
though I
course.
guess maybe not quite a startup after 10 years. But, I have a lot of concentration in basically a risk asset already. So I look at real estate as something that's a nice hedge against what I'm doing on the equity side, has a different kind of profile from a cash flow perspective. And, that's how I like to construct it, at least now. We'll see in 5 or 10 years.
In the equity side, you're doing indexing, but if I'm correct, on the alternative side, inside the real estate, you're doing quote unquote real estate picking, meaning you're
Yeah,
not doing that REIT, you're doing one asset at a time. So it's the exact opposite of
the
your
exact
perspective.
opposite.
Yeah, so that's really interesting. So
But
can you
look, I
just,
guess the one thing I'll say there is I do go for diversification, right? I'm not putting in all my chips into one basket. I think just like we preach to our investors, build diversification. Even if you're picking one deal at a time, you can still build a diversified portfolio that way. You just have more control over it.
How many investments do you need to have to feel diversified, in your opinion, in real estate?
It's a good question. I mean, I think I would look at optimally, you're looking at like 10 probably. You start to feel diversified probably at 5. But, we look at our investor portfolios and the people who have the lowest volatility, of course, it's all just the math of having more investments.
Great. And just because so many people love to talk about crypto, I have to ask, crypto's BTC, Bitcoin, is over 100K right now. It doesn't sound like you have much exposure there. I'm sure somebody's told you maybe you should put in some exposure, and I'm sure you've made a decision multiple times as to what you're going to do there. Can you just give a little bit more thought as to what you're thinking related to Bitcoin for the
Yeah, look,
listener?
I think Warren Buffett's view definitely seeped into my brain a little bit, which is when I can't tie the value when it feels like this is based purely on trust. Look, like gold in many ways. So it's not to say those trust assets can't be sustainable, but it's just harder for me to have a long-term view because I think ultimately it's tied primarily to consumer sentiment, right? And if I were deeper into the Bitcoin market, if I understood the underpinnings of it a little better, I'd feel more comfortable. But that's not my area of expertise, and I probably should have some amount in, candidly, but I'm not buying in at 100.
So I know you're not on the show to ask for any investment advice, but I would suggest, given your mix right now, that you should take 2% of your net worth, which if you had $1 and you lost 2 cents on the street, you might not notice it. And you should put that into Bitcoin. Even at 100, it might go down to 50, but there is a decent chance in the next 15, 20 years, it's going to hit 1 million, if not significantly more. And I do think it's a good diversification for you, especially given the two assets you already have mostly. But that will be the end of my suggestions.
No, look, I will say you are correct. I will follow all your advice. I might try to wait for a little bit of a dip, but I know I should have some money in there.
I mean, you should just DCA in, dollar cost average in. I don't think you should overthink it. Like I said, it's such a volatile asset that if you lose all 2% and it goes down to zero, you're probably not really going to notice it that badly.
But the upside.
But if you do 10x it, or who knows, maybe even more, all of a sudden it's 1/5, if not greater, of your entire net worth, which is kind of interesting for just the 2% position.
No, 100%. I have a buddy who lives out in San Francisco, maybe unsurprisingly, who's gone 100% into primarily Bitcoin, but spread through a couple other Bitcoins too. And he's built AI agents to manage his portfolio. So they do all active trading for him. And he's, of course, been very evangelical to me. In a way, maybe I feel more scared after talking to him
Well,
than
that
I
sounds a
did
little
before.
crazy. That sounds crazy because
He's a little crazy. He's a
that's
little
very
crazy.
high risk, and that's obviously can have massive implications on your overall portfolio. I'm
Oh,
suggesting
he plays in the World Series of Poker too. So,
right,
if this paints a picture.
exactly. I mean, you're 50% in indexes and 50% in real estate, so I doubt you want to be all in on crypto. But I do think if you put 2% in, lock the keys away, quote unquote, close your eyes, don't really look at it, and
Think
just
about it in a decade.
and minimum,
Yeah.
minimum.
Yeah.
Exactly. Okay, so let's move on to the next question, which is right up your alley. It's gonna be a big question. You can take it wherever you want, which is where are we at right now in the market? And what I mean by that, we're talking stock market, we're talking real estate market, we're talking inflation, jobs, we're talking tariffs, we're talking economy, we're talking global, macro, everything. Just take it wherever you want to take it. Say anything you want about any perspective. We just want to hear the Charles Clinton perspective.
Yeah, absolutely. I mean, as you imagine, I spend a ton of time thinking about this. I think the candid answer for everyone is who the hell knows, given how much rapid change there's been over the last 5-6 months. But look, I think that the worst version of events, which was a month or two ago, trade war, especially with China, but really we're going against all of our ostensible allies too. That was a big shock to the market. Obviously, that was a great short-term buying opportunity, and it feels like the gas is out of that car right now. That there's positive momentum to reconciling to something that maybe is different than it was 6 or 12 months ago, but is more in line with the existing system. It's not trying to break the system. It's trying to get a little bit more to the American agenda. And I think for most businesses and most investors, that's really the preferred outcome, right? I mean, for me, certainly as a business owner, predictability is the name of the game. I think that stocks as a whole are overvalued. I think that the dip we saw in response to tariffs, it came in response to tariffs, but really you could also say it was just the beginning of a normalization of multiples. So, I looked at that as a time to buy in, put some additional, cash into equities. But I'm not convinced that our ride in equities is done. I think there's a lot of factors. It's what impact tariffs actually have on inflation, what our growth prospects end up being, and ultimately, like, what's the performance level, especially of the top 7 companies, which are driving candidly too much of market performance right now. I think that the next Fed meeting for interest rates is going to be really interesting and important. Look, the inflation data came in cool. The last inflation data, I think, kind of defied expectations. Coming in at 2.3%. No tariff impact is in that data yet because it's backward looking. I think what tariffs do is still pretty TBD. I mean, I've read a lot about it, but given how much the tariff environment has shifted, how rapidly, I don't think anyone has a good handle yet on what the actual impact to consumer pricing is going to be, and where exactly that's going to be felt. So I would expect it's going to have some kind of price pressure. But with inflation data coming in cool and the Federal Reserve certainly mindful of the job picture, which has been uneven, some months it's discouraging, some months it's a little more encouraging, there might be enough room for, the Fed to lower interest rates, sometime in mid-year or in the third quarter, which, 3 months ago, I would have said there's no chance in hell of that happening. So, moving out into real estate, look, obviously lower interest rates are good for growth across the economy. It's good for consumers. It's good for consumer spending, which powers so much of American growth. But for real estate specifically, it's obviously a great thing. So, interest rates really, really hurt the market. It hurt valuations. It hurt just the number of transactions happening. But since the first interest rate drop in September, things have definitely improved from just a transaction velocity perspective. Look, the market's been down so long that at some point sellers have to sell, especially if there's no, hey, rates are going to drop to 1% and we're going to get saved. So the market's definitely been better over the last 6 to 9 months.
The market being the real estate
The real
market.
estate market. Yeah. And, I think what we're seeing that's really important is we're seeing properties trade for the price that they should, given where interest rates are. For a long time, the sellers were saying, no, I want to sell for the same price I could have sold at in 2021. But when interest rates go up, that's not the price anymore. Now sales prices are down. So we've really tried to be as active as we can because we feel like we're buying in, at a good valuation, right? And looking out in 3 or 4 years, the really interesting thing is interest rates come down. That's not just giving you better cash flow in real estate. Really, that's giving you a better valuation, right? So interest rates come down, cap rates come down, valuations go up. So you really could be entering this environment, which has not existed since, 2010, 2012, where you buy in at one interest environment, you exit at another. And as a result, you're getting this valuation pop that really isn't tied to, the NOI and performance of the underlying investment. So that's what has us, really excited on the equity side. We were really cautious on the equity side for the last few years, but, we've really dived back into real estate equities. And then look, we like real estate bridge lending too. With rates high, you can just lend at rates that you haven't been able to lend at in 10 years. So we continue to like that vertical for kind of fixed income, but real estate equities, I'm excited to, kind of plow more into that because we're off the bottom. And I think that there's less uncertainty in real estate than there is in, the stock market and in some ways the broader economy.
So lots of good thoughts there. You gave us some general directions. I'm going to put you on the spot, though, a little bit of lightning round here about what does Charles have to say about specific questions. So recession, next 6 to 12 months, yes or no?
I mean, 2 months ago, I would have said yes, definitely. Now I would say we're 50-50.
Got it. How about what's happening with inflation? You think it's that 2.3 cool number is going to continue to be cool and it's going to be a potential we got to be worried about prices coming down, or is it the opposite? You think tariffs are going to be hitting soon, and who knows what's happening, and inflation going to be happening over the next 6 to 12 months?
I think it's going to tick up, but it's not going to spike.
So you don't think that it's coming down significantly, but it's going to stabilize
Yeah, no, I look, I think it's going to go up in the short term
because of
because of
tariffs,
tariffs,
right?
but we're not going to see 5%, I mean, hell, we saw as high as 7, 8, 9% before, but I think it'll go up I think 2.3 is going to look like the floor for right now. Tariffs will send it up. And then I think we'll see a normalizing track once the market, absorbs the new normal from a tariff perspective.
And you gave us some direction on rates, but be a little bit more specific. You said the next meeting, but give me your crystal ball. Obviously, this isn't investment advice, but it's for the sake of the show. What's happening in the next 6 to 12 months on rates?
Yeah, I would project we have 2 to 3 rate decreases this year. I think, 2 is probably what I would peg. But I think there's real estate recession and interest rates. There's a little bit of a mixed bag in there for the economy and for real estate in particular, right? Recession's not good because people have less money to spend, but interest rates will drop faster. I think that I don't have a solid view that we're going to plunge anywhere bad. I feel like the fundamentals are pretty good. Could we have some kind of near-term recession that's not a deep one? Absolutely. But I think we're going to see moderate, kind of gradual declining of interest rates unless something unexpected happens.
So, just to be a little provocative for the sake of discussion here, do you think a few months out, because of this, let's call it not too hot, not too cool, rates starting to maybe come down a little bit, do we start getting into Goldilocks? Does it start getting like kind of exciting where it's almost like too good to be true because it's just nice and steady and not too hot?
Yeah, look, I think that's obviously the scenario that everyone was saying. Look, the soft landing is coming. Somehow the Fed has executed this thing. Tariffs have thrown a huge wrench in that.
Totally.
Given that tariffs have scaled, look, I just feel like my gut is the final product on tariffs is not going to be massively impactful to the economy one way or the other. I, of course, could be wrong. There's a lot of unpredictability. There's a lot of posturing. It's negotiations. I get that. But given the track of this, which is let's light the world on fire, and now it's deal mode, it feels like this is not going to be as disruptive. And there's at least a chance that the plane can land in something that doesn't look like, hey, maybe we're not jumping into high growth, but we're not looking at anything major in terms of recession risk.
All right, great. Um, let's talk about your company. So you already gave us some high level numbers. You kind of foreshadowed already. So I think you said 240 transactions, $700 million of investment, over $5 billion of real estate that you all have invested into. Those numbers are huge. You've been around for about a decade. Obviously, a lot of people know who you are, but not everybody. So can you just start from the beginning? Like, what is Equity Multiple? Who uses it? What's it for?
Yeah, we're an online real estate investment platform for accredited investors. Fundamentally, we want to make investing in real estate as easy as investing in stocks and bonds. So our experience is going to be very akin to a brokerage account. You sign up, you create an account, you link your bank account, and then you log on and you see investments. And we bucket our investments, roughly into the concept of stocks and bonds, right? So we have fixed income, which might be bridge lending in real estate. And then we have equities, which are going to be a kind of 3 to 5 year business plan, going for a higher return. And, look, just like managing a portfolio, right? We encourage diversification. So we have low minimums as low as $5,000. Some products, more typical is probably $15,000. But really, we're trying to facilitate building a portfolio with us. And on average, our investors have invested 6 times or so a piece with us. Are investing $25,000 or $30,000 at a clip. There's a huge range, obviously.
Sorry, 25 times 6 or 6
Yeah,
equals
25 or 30 times 6. Yeah.
Wow,
Yeah.
that's an amazing average.
Yeah, so we're obviously proud of that, and we think that is the right way for people to build. We keep pushing that number. Used to be 4 per an investor. Now we've seen it grow to 6. I mean, as I said, I would love to see it at 10. But we're keeping those minimums low. We're offering a range of investment types. The other is we have fund options, right? It's set it and forget it and invest in something diversified. And then we have individual property options. And we have that in both equity and we have that in debt. We have variety of property types. I can get a little more into that later, but really we're using our credit hats as investors to pick these investments. We're picking 5% of the investments we see, try to curate that for you. But ultimately, it's up to the investor to decide what particular investments they want in their portfolio.
Got it. So I have to be accredited. This is a real
Yep.
estate opportunity. I could get into the equity side of the real estate, which is a little bit more risky, or I could get into kind of the fixed income version of the equity, which a little bit less upside, but more kind of a guaranteed annual amount. I need to put in at least 5K into some of the products. And you said some of the products that might have to do 15K. Is that right?
Yeah. I'd say our lowest is 5 and highest is probably 25 or 30.
So if I go onto the site, it, there's going to be a bunch of options. So are there fund options where I don't have to do the, let's call it the stock picking, meaning the real estate picking, or is it all picking?
Yeah, no, we have fund options as well. So we have on the bridge lending side, on the fixed income side, we have a fund called the Ascent Fund. So that is, just focused on bridge lending, focused on giving a current cash distribution. And then on the equity side, we don't have a permanent fund yet. We're planning to, launch that in the future. But we'll have some funds from third party sponsors. We might have a self storage fund or multifamily fund. And then we also have some portfolios. So 5 multifamily properties, 5 industrial properties. So the portfolio is already built for you. You don't have to do anything.
Got it. And I know you can't guarantee results, but what kind of results are we talking about in terms of like this debt fund or getting into a diversified portfolio of like these equities or these debt plays?
Yeah, so we're targeting like a 10 to 12% current return on the fixed income side, on the debt side. Generally, we're targeting kind of high teens and above total. These are annualized returns, total annualized returns on equities. And some of that will on equities, some of that will come through cash flow, but a lot of it also will be realized upon sale.
Amazing. Are these all real estate that you're managing, or is it that you're picking that somebody else is managing and you're saying these are good choices that they deserve to be on our platform?
Yeah, so it's a little bit of both is the answer. So, we do have some competitors who are pure marketplaces, right? They list an investment from a third party sponsor. The sponsor does everything. The sponsor reports to you, at least hopefully they do. Our model is a little bit of a hybrid where we also kind of act as an asset manager. So we always work with third party operators. And so we'll find, people who are specialized in industrial or in self storage or in multifamily. And they're bringing us the investment. We're underwriting the investment. But most of the time, we're also, a partner in the investment. So if something needs to happen, if they want to refinance, if they want to sell, if they want to change the budget, we have say so in that. So we have a internal asset management team. It's led by a guy who, spent 2 decades in the institutional real estate world. So they're monitoring their portfolio. They're involved in major decisions where they need to be. They're the ones doing reporting to investors on a quarterly basis. So, we're not buying and holding the real estate ourselves, but we're very much involved in the project.
So let's say I'm new to real estate investing, or I'll just be that proxy myself. I don't have much real estate investments. Why should I get into real estate? More importantly, why should I go through you guys and invest through you guys? Like, how should I think about using your platform to diversify my portfolio?
Yeah, absolutely. Look, I think that for investors who don't have alternatives as a big part of their portfolio, real estate's a really common place to start. And there's a variety of reasons. There's jargon in real estate, but at its core, real estate is something that's pretty simple and that we interact with every single day. And it's, people pay rent and you have pretty basic expenses, right? It's sort of it's a P&L that people can get up to speed and understand pretty quickly, which is, I think, nice from a new entry perspective. The other thing is the profile, right? So, real estate's really known for being a combination of cash flow driven and value appreciation. And, that is something that can be complementary to what you have in stocks and bonds, particularly in today's market. Your distributions coming off of your S&P stocks are, going to be pretty marginal. While you could have a more even split in terms of how you're making your return in real estate. So I think, those are some of the core benefits. The other piece is tax. So you get depreciation benefits if you're an equity investor. We've set up all of our investments in equity to pass on those depreciation investments. So basically, you can shield some of your income coming off of that real estate if you make that 6% return. A lot of the times, you're not paying any tax on that in that year because you get deferral because of depreciation benefits. So it's just a different kind of profile that is a nice way to diversify because of that different profile, and also just a nice educational entry point for a lot of folks.
You,
In terms of us in particular, look, I think we offer a couple things. We offer education and transparency on the upfront. So, we want you to get up the learning curve, and we try to help you do that. And you'll get a lot of resources from us. We have people available to speak on the phone. We have a 10-year track record. We have really institutionalized an old-fashioned business of doing these, kind of club deals. And, look, I think the standardization and visibility is really the major benefit. And for us in particular, we also offer these diversifications benefits and the active management that I think not a lot of our competitors can. So, you can really know that we're doing a lot of the heavy lifting for you. We're making this easy, and you can monitor your portfolio. You can understand it. It's not a black box, which is what real estate investing looked like 10 years ago when we started this.
and you mentioned that it's targeting like 10 to 12% on the debt returns from the fund, or high teens for the equities. Is that including fees or not including fees? And what are
Yeah,
your fees?
that's net of fees. So generally, the only investor fee that we charge is an annual asset management fee that's typically 1%. That's taken out of distributions. And then we also make transaction fees when the investment closes, and sometimes we'll make fees from the borrower or the sponsor, basically upon success of the project. So, we try to align our interests in terms of how we're making money, and try to, again, that fee that's really the investor fee is a 1% annual.
So you had a lot of perspective on the macro and the market. How about the specific real estate opportunities? So what would you be guiding our listeners right now? What do you like? What do you not like? And what I mean by that, give me two geos that you like, two geos that you don't like.
Yeah, absolutely. So I would say we're a little shy on some of the Florida markets that we were bullish on a few years ago. So, there's just a ton of weather exposure and insurance cost exposure that I think is really tough right now.
So you're short.
Despite
You're short Florida right now.
Yeah, look, I think it depends on the exact location, and it depends on the property type.
Of course, of
But,
course.
say Tampa Bay, right? You've seen major weather events there that are extremely disruptive. Obviously, on the other coast, you've seen the same thing. So you got to be really selective, and you got to be really smart about your insurance costs in particular, really mindful of that stuff. We are similarly, I think honestly, a lot of this comes down to the particular property type. We have been really anti-California. I think there's a case for San Francisco now that it's, gone through such a shock, but it's a really hard place to do business in. There's a ton of regulation. The laws change. They can affect your ability to charge market rents. It's the economy and political environment, I think, that make it challenging rather than, necessarily the growth prospects of the state long term. In terms of markets, we
Yeah.
like Texas. So Texas has had a lot of people went bust in Texas. A lot of syndicators went bust in Texas, and that's created a lot of good opportunity. And you have to be careful in Texas because it's so easy to build new. But there's so much demographic movement in Texas. People are always moving to Texas, which is, obviously just core to real estate, right? More people come in, demand grows. So we have long been Texas folks. We continue to invest there. And then I would say one where we're bucking the trend a little bit. A lot of people have been anti-New York, but, this is our backyard, and we have a lot more visibility into it. And I think every time that there's been a New York is dead case, which has happened, 3 or 4 times over the last 20 or 25 years, it's always proved incredibly resilient. And look, there's particular political risks here too, no doubt. But if you're in the right property type, the stability, the liquidity of the market, the amount of institutional capital that wants to participate across the globe, those are factors that are not going to unwind. So if you can buy in cheap because other people aren't into it, New York is still an interesting place for us.
So New York is New York City, not New York State.
Yeah, New York City. New York City. Look, on a personal basis, it's hard to get much that's like scaled that makes sense. I think that there's markets that are upstate that if you want to own an Airbnb are pretty interesting. But, for us, that's more on the commercial side. We really are New York City focused.
You mentioned the real estate type a few times. So give me some perspective there. Give me 2 or 3 pluses, 2 or 3 minuses. What do you like? What do you not like?
Yeah, so look, we always are long housing. There's definitely markets where they built too much housing in the last cycle, but we're chronically unsupplied in the country as a whole. And then even in the markets that got overbuilt, the interesting thing we're seeing now is interest rates went up, people slammed on the brakes of new construction. So, there's just less inventory coming on. Now those apartments that were overbuilt before are starting to fill up. So, we have views on, hey, look, Philadelphia, for example, they got overbuilt. It's probably going to be another year or two before that rent growth starts to grow again. But in a lot of places, there just is national undersupply, and multifamilies really emerged as the most core institutional asset class too, which is just good for maintaining price stability. So we always like multi. We like small bay industrial. So different set of reasons, ton of mom and pop owners in small bay industrial who are just, underutilizing space, don't want to put any money into it. Even if it's getting a big rent bump, maybe they don't know that, they're charging too little in rent. And if they gave a tenant $400,000 to fix up the space, they would pay $10 more. But we've seen good results there. And of course, the continuing growth of logistics, e-commerce. And, I think it's yet to be seen what happens with this. But if there is any real movement over the next 4 to 8 years because of political industrial policy and reshoring, that is kind of unwritten upside into the industrial category. The interesting one is office. It's the one on everyone's lips.
Sorry, is office an up or a down?
It's a deal by deal, block by block, market by market. So we were a hard no on office until recently. Felt like it was a falling knife and we didn't know where it was going to land. Valuations are way down.
Right.
We've seen individual properties, the valuations go down by 80%, depending on where you are. And, some markets are just never going to go back to where they were. On the other hand, some markets have been more resilient and you're still getting massive discounts. So I'll give you a more specific example. We just participated in an office deal in Long Island, close to the city, but it was purchased for around 100 million by the seller. They put some more money into it. It's close to 90% occupied. The occupancy in the market is strong. COVID, it wasn't really the same impact there as it was in New York City. Not everyone was worried about wearing their masks every day. You didn't see the huge fall off, even though it's only 20, 30 miles away. And the purchase price on that, purchased through the bank because of foreclosure, is 40 million. So you're looking at a 60% discount off of something that was producing stable cash flows. It just was over-levered. They couldn't sell for that price. And now you're stepping into something that has great cash profile right away. And obviously, if there's market recovery in terms of how people view office, which we're optimistic there's going to be because they can't get much lower than this, there's a real upside case. So I'd say with office it's your high risk, it's your high, variance play right now. That's where people will make the most money in real estate in this cycle, I think. But obviously, there's going to be some losers there too.
What are the things you're trying to stay away from?
So, look, I would say it's office. I think that we are really selective on retail. There's some forms of retail in the right location that makes sense, but retail had a surge back after everyone thought it was dead. And I don't know how much wind is left in the sails for retail as a whole. I mean, you see so much bad activity with the large scale retailers. Smaller retail is holding up better. You're sort of in some case, maybe it's a grocery store and a bunch of small stores around it that are local stores. That stuff's doing okay. But with the pressure on kind of big box of all sorts across the board, I think it's hard to know what that space becomes and what the values are there.
All right. You've given us a lot to think about, a lot of good information. Anything else you want to cover on real estate or equity multiple?
No, I've yapped on long enough. Let's do something else.
All right. So obviously we all want to be as smart as you, as knowledgeable as you in the space. What do you like to listen to? What do you like to watch? What do you like to read? What informs you? Just give us a few examples of that sort of content.
Yeah, so I'm a stalwart news person. So I read just about everything that comes through my feed. And I feel like staying very, very up to the moment's just essential for what I do. Don't do some podcasts. I love, what's a couple? I like Plain English a lot, if you know that one, with Derek Thompson from The Atlantic. In general, I'm doing not real estate focused kind of stuff. I'm really trying to get broad view, understand what's happening in the world, understand what's happening in the economies, listen to smart people. You know, there's you guys obviously run a great podcast, but I love the long form interview podcasts. And honestly, the thing that's changed most about my consumption of information over the last 6 or 12 months is AI. So it's not filling in the bucket for news, but the way I search for information is just totally and irreversibly changed. Google if I need to find a website, if I need to find out information, I'm on ChatGPT. If I need to learn about something, I'm asking ChatGPT to structure me a lesson plan. So, hey, what book should I read on this? What articles should I read on this? What should I listen to about this? It's an incredible resource for that particular task. And of course, just, summarizing complex information and making it quick. So, that is the biggest change that's happened over the last 6 or 12 months. It's honestly, in terms of my just self-education, it's gone from zero to the majority over the last 6 to 12 months.
So that's a great learning. Can you give us an example just for the listeners? So what does that mean? ChatGPT creates a lesson plan for you. Can you give an example that you did recently where what you used it for and exactly how did you use it?
Yeah, I mean, so this is a really in the weeds one, but we're looking at a different type of real estate investment vehicle. Basically, it's a type of tax deferred vehicle where people can contribute properties into a fund tax free and then own interest in the fund. So, I heard about a business doing this. Given the way we're situated, we have a bunch of properties already. We work with a ton of operators. We also have a partnership with Marcus and Millichap, which is, the largest commercial brokerage by number of transactions in the country. And they're doing a ton of these sub 20 or $30 million transactions. So, I knew about this, but it's tax driven. It's complicated. It's nuanced. If I call our lawyer about it, it's going to be 3 weeks and $20,000 to get to a basic level of education. So I plugged into ChatGPT. Here's what I'm thinking. This is what I want to get smart on. What are the pitfalls? What are the opportunities? What's the competitive set? Give me resources. And, it spat out a 10-page summary of all the complexities of it. It's gave me 20 links to follow to get more in depth on a particular thing. Can't say there's any podcast covering that topic, so I didn't get any recommendations there. But, it's really anything you can think of. You can get it to educate you and educate you rapidly.
Did you recall how you had to structure the prompt to make it get you the answers you needed, or do you have to try a few times to get where you needed?
So I use the prompt, give me a lesson plan, or sometimes I'll start with, here's what I know about this. Give me some basic information about it. And what am I not thinking about?
Awesome.
And that'll start to build. And then, it's like, I think ChatGPT, when I first used it, the prompt game is unfamiliar. And then just like using Google, you kind of figure out what the native language is pretty quickly. So, I would encourage everyone who's not using that as their Google alternative to get on board, because it's the future.
Amazing. Well, we have covered quite a bit, Charles, from you graduating law school, deciding to get into law in real estate, and then deciding I have to get on the other side. In 2015, you started Equity Multiple, and obviously it's been an incredible ride. You're very much into real estate on your own, about 50%, and you're very much into indexing into equities on the other side. I love that you're pretty much just two completely opposite positions and two completely opposite approaches. You're not into crypto, but who knows? Maybe after this podcast, you might get into a little bit of Bitcoin. You do think the market, the predictability is key. The stocks are overvalued, which was a great hot take. The interest rates are coming lower. You're 50-50 on recession. Inflation was just at 2.3. We might get a little tick up, but you're not too concerned. And you are thinking maybe 2 or 3 rate cuts in the coming quarters. The plane may be able to land, you mentioned. EquityMultiple has done over 240 transactions, $700 million of investment, and $5 billion of real estate value. Incredible. My favorite part is you already have investors doing 6 average investments at about 25 to 30K per investment, which is amazing traction and really speaks to the investor coming back and working with you guys. A really interesting returns from 10 to 12% on your debt fund to potentially high teens on the equities, lots of different options. We then got into what you like and you don't like, which was really interesting. So the geos like Texas or New York City, you like. Tampa, Florida, or California, you stay away from. There was also the vertical slices. You love housing, you love multifamily. I think that was pretty consistent. The one that was unique was the small bay industrial, which really hot take there, especially with reshoring in America. Office, you were 50-50. You have to really find the right opportunity like in Long Island. But otherwise, you stay away from office and retail. You gave us a real good idea about how to use ChatGPT. So if everybody's not already doing that and creating their own lessons for where they need to learn, we learned here from Charles how to do that. Charles, thank you very much.
Thank you, Slava. You were not kidding when you said you were taking notes.
Have a good day.
Smart Humans with Slava Rubin is a podcast brought to you by the team at Vincent. Any data, text, or other content in this podcast is provided as general market information and not as investment advice. Past performance is not necessarily an indicator of future results. For more information on alternative investing, check out Vincent at www.withvincent.com.